Travis, today we're digging into private credit news. The spotlight is on Blue Owl Capital, who has been in the media quite a bit this week because of selling some debt that they had.
Yeah, and Blue Owl, Steve, is one of the biggest private credit managers in the United States. It made a move last week, and it sparked a lot of market chatter because the firm sold about $1.4 billion of direct lending assets. And they sold them to institutional investors. So when you think of institutional, think of like pension plans, insurance companies, and they sold them close to fair value.
Yeah, Travis, the market saw the media headlines and everyone's phones started buzzing. Shares of Blue Owl and its peers dipped because many interpreted this as a sign of weakness or distress, especially since the company has also moved away from quarterly redemptions in its fund.
Yeah.
Okay, but the CEO's message tells a much different story.
Yeah, so Craig Packer is the CEO of Blue Owl's BDC platform, and he said, the interest from the institutional buyers that I just talked about exceeded what they actually sold, right? So they're like, hey, we'll buy more, but they didn't fill, what they actually wanted.
Right.
They sold what they wanted. So that, in his words, reflects strong demand and confidence in their underwriting of the portfolio, the underwriting of the loans in the portfolio. So this isn't a panic sale. It's more of a strategic, opportunistic transaction. Yep. And they basically got it done at full value. 99.7% of par is what they sold that part of the portfolio for.
And Travis, that's critical. The narrative from the company is that it wasn't a forced liquidation. It was a chance to return capital efficiently and position the fund better for the environment moving forward. Mm-hmm. Blue Owl is actually using part of the proceeds to return 30% of net asset value to investors.
Speeding up liquidity,
yes,
actually, yeah.
Yes, and to pay down debt also, which is very important for those types of funds.
Yeah, but the headlines aren't going to spin that narrative to you, Steve.
I mean, that doesn't sell.
Yeah, they're gonna what they're gonna do is focus on redemption mechanics here, right? And when you focus on that, if you don't understand it, it'll spark fear, particularly among retail investors who might be new to private markets or these type of vehicles, right?
Yep.
So some advisors, even reported clients calling to pull all their money out because they're like, hey, this fund's going to close up shop, right? I want all my money out.
Yep.
And even though the company emphasized that these types of liquidations are going to support future distributions from the fund longer term.
Yeah, Travis, that mismatch, headlines versus executive intent, is exactly what we're talking about here on the Capital Exchange when we say private credit isn't broken, but it is misunderstood, right?
Absolutely.
The sale was near par, and the buyers, who are sophisticated institutional allocators, they weren't buying this on a fire sale. You mentioned earlier, I think, that it would have been a lot lower than that.
Yeah, it would have been 80% or even lower,
or maybe
right? If it was on fire sale, maybe. Yeah. So, but part of this, Steve, is just how private credit works, especially if you're used to, how public markets work. Yeah. If you're using that is what you're familiar with, then you're misunderstanding what's going on in private markets, because these investments aren't traded daily like bonds or stocks, where you can go out and get a bid any second of,
right.
Of any day. So the stories about liquidity or freezing redemptions, they get amplified even more when the firm, is just adjusting to the terms, and they're trying to be realistic about liquidity, especially in these type of vehicles that aren't public. So.
Yeah. Blue Owls. So here's the takeaways, Travis. One, Blue Owl's move was not a distressed sale. It was participation in a strong institutional bid at fair market value.
99.7%.
Yeah, near fair market, right? And so the CEO's narrative, second one is the CEO's narrative reinforces confidence in the underwriting and portfolio quality. He's explicitly framed it as a validation for sophisticated buyers. And then the third one is market psychology, triggered by headlines about redemption changes. And it fed uncertainty, which is this is a perfect example of what the media can do and how they can completely make something that it's not.
Yeah, and if you don't understand it, or if you're basing your knowledge on public markets and how they function, then the privates or these type of funds are definitely going to confuse you or cause you some anxiety if you don't understand what's going on.
That's
so,
true.
This is a good example, Steve. I mean, interpretation of actions matters just as much as the actions themselves when you're looking at sentiment on these. Investors, they're a little more aware of the liquidity mechanics in these private funds, but they still have a lot more to learn just on how private markets work to get comfortable with it. But my takeaway here is keep educating yourself on this, because private markets are pushing further into the retail world. So you're going to get exposure to them. Don't freak out on any headline about liquidity, because that's one of the biggest differences between privates and publics is liquidity. So work to understand that better.
That's true. And as we've talked about it before, that's why education, as you mentioned, and communication from managers is important, and smart diligence from allocators as well are vital. Private credit's growth story is not over.
No.
But it's definitely entering a more mature phase where transparency and content are going to be important as the yield for seeking these types of investments.
Yeah, understanding what you're investing into, understanding the liquidity and the return profile are going to be very important here. So a lot of education.
It really is, Travis. It's been great. I look forward to it next week.
Look forward to it as well.
Yeah.